Yes, well, we've, for about the last week or so, moved to a more cautious perspective. We did buy back into markets, not quite at the lows, but not very far off, because we felt that they had got rather oversold, at least on the basis of the information we had about a month ago. And at that time, we sort of set levels where we thought a rally could go. It seemed slightly outlandish at the time, to be honest, but we're there. And this zone we're in right now, between 2,800 and 3,000 and the S&P, is where you really start to meet some technical resistance. And on the fundamentals, of course, there's still an awful lot to be questioned. And I think the biggest question of all is, aside from coronavirus, and we've all done a lot of studying of that as best we can, but aside from that narrative, perhaps the bigger narrative, which is yet to fully develop, is the economic one. And as we're all aware, the impact on the employment markets has been much more severe than anyone would have imagined. So that's still to ripple through. So we do think that now's a time to take stock. I wouldn't want to fall into the trap of necessarily being a perma bear, but there are big issues here, and I think this is a good level to sort of sit back and take stock of the situation.
The challenges of going to negative at this point, Chris, seems to be just the flurry of announcements we continue to get from central banks and Treasury departments offering support for all sorts of sectors of the economy. It does make it challenging to take too negative a view on the direction for the headline market. How do you weigh the support that's being offered for different sectors with the desire perhaps to step away from the rally?
Yes, that's exactly right. It's the unstoppable force meeting the immovable object, isn't it, in terms of the might of the stimulus which has been applied both from governments and from central banks. But as we know, the economy is at a standstill and it needs to be got going again. But yes, you're right. That's the single biggest reason to be wary of becoming too bearish. Get stuck in a mindset. I think it's important to keep a flexible mindset at the moment. And we know that policy works eventually, and sometimes it works too well. And it's possible that 6, 9, 12 months down the line, you get quite a vigorous response in asset prices. So that's reason number one on the kind of the positive side. I mean, the other is that despite the size of the rally we've had, our indicators suggest that sentiment is still pessimistic amongst investors. And actually, that tends to correlate with better returns. So that's something else to be aware of. On the other hand, the technical picture, as I mentioned, is very challenging. And we know that bear markets tend to come in waves. If we see the economic situation deteriorate, that could trigger the next wave. So it really is balancing up these forces at the moment. And keeping an open mind is exactly how they would play out. But I would say right here, right now, we think the risk-reward ratio is unfavourable, and the upside is getting thinner, more limited, meeting more resistance, whereas the downside in the short term, at least, could be a bit bigger.